Welcome to the Insurance Contracts webinar on Simplified Accounting for Contracts with Shorter Coverage Periods, the so-called Premium Allocation Approach. This webinar is part of the series that the ISB produces to support the implementation of the new insurance contract standards. My name is Maria Karamanu and I'm a Technical Associate on the Insurance Contracts project.
Hello, my name is Isabella Ruta. I'm Technical Manager also in the Insurance Contracts project.
Before we start, as usual, the views expressed in this presentation are those of our own, not necessarily those of the International Accounting Standards Board or IFRS Foundation. A copy of the slides used in this presentation is available for download on the website. Those slides are accompanied by additional material that we hope you will find useful. What is the topic of today's webinar? This webinar is the second part of the discussion about the premium allocation approach. The previous webinar discussed scope and part of the measurement relating to the liability for remaining coverage. This webinar will consider the remaining part of the measurement requirements as well as presentation and disclosure requirements. Let's start with the second component of the insurance contract liability, the liability for incurred claims. Liability for incurred claims is the obligation to pay claims that have already incurred during the coverage period. In the next slide, let's explain how to measure the liability for incurred claims. The liability for incurred claims is measured in line with the core requirements, comprising of the present value of the expected cash flows and the risk adjustment for non-financial risk. As an additional simplification under premium allocation approach, IFRS 17 provides a practical expedient related to discounting. Please note that next slides will provide a high-level overview of the core requirements used to measure the liability for incurred claims. More information about the core requirements could be found in the previous webinar focusing solely on the core requirements. Regarding the first component of the liability for incurred claims, the present value of the net cash flows. Which discount rate should bring those cash flows into present value terms? Using core requirements, the entity will account for the time value of money to reflect the timing difference between the occurrence and payment of claims. To reflect the time value of money and the effect of financial risk, the entity will discount the expected cash flows. It's worth mentioning that the estimate of the expected cash flows, for example, the claims to be paid or claims handling expenses, is probability weighted and unbiased. And the rate used to discount the expected cash flow should be current, market-based, and should reflect cash flow characteristics such as, for example, liquidity. As discussed on the previous slide, applying the core requirements, the entity is required to discount the expected cash flows related to incurred claims using a current discount rate. However, IFRS 17 allows additional practical expedient for contracts measured using the premium allocation approach. Applying this practical expedient, an entity does not need to discount the incurred claims if the time difference between the date those claims are incurred and paid is no more than a year. Regarding the second component, the entity uses the core requirements to estimate the risk adjustment. Applying IFRS 17, the risk adjustment reflects the compensation the entity requires for bearing the uncertainty arising from non-financial risks. The risk adjustment in the liability for incurred claims reflects the unexpired portion of non-financial risk for claims not settled yet. The uncertainty measured by the risk adjustment could be related to the timing or the amount of payment of claims, or both. IFRS 17 does not prescribe a technique to measure the risk adjustment. However, it requires that it should be an entity-specific, explicit measure. Moving to the loss component of the liability for remaining coverage, how do you measure it, Isa?
Let me start by saying that the requirements related to the onerous contracts for contracts measured using premium allocation approach are also simpler comparing to the core requirements. This is because for those contracts, the entity is not required to constantly update estimates, as we already discussed in the previous webinar, but also those contracts are considered onerous only if facts and circumstances indicate that. In order to measure onerous loss, the entity should compare the carrying amount of the liability for remaining coverage with the fulfillment cash flows relating to the liability for remaining coverage. So the carrying amount of the liability for remaining coverage will be measured by allocating premiums, again as discussed during previous webinar, while the fulfillment cash flows relating to the remaining coverage will be measured using the core requirements. The simple example on the slide illustrates that calculation. So if the fulfillment cash flows relating to the remaining coverage are greater than the carrying amount of the liability for remaining coverage, then the entity should establish a loss. And as you can see on the slide, the loss calculated in the slide is CU 300. That loss component will be recognized immediately in the profit or loss as an expense. Subsequently, the entity will remeasure the loss component until it is zero. Because the loss component is part of the liability for remaining coverage, it must be zero at the end of the coverage period. Now, let's think about how are we going to measure in insurance contracts. The insurance contract liability is measured for a group of contracts. The consideration for establishing the groups of contracts for premium allocation approach are not significantly different comparing to those measured using the core requirements. The entity will use a two-step approach to consider groups of contracts for the measurement purposes. As the first step, all insurance contracts are going to be allocated to portfolios based on the similar risks and whether they are managed together. For example, as you can see on the slide, different portfolios will include worker compensation and car insurance. This is because they are based on different risks, and they are also likely to be considered separate product lines for the management purpose. Now, let's think about the second step. As the second step, a portfolio is further divided into groups based on profitability, resilience to changes in estimates, and the dates the contracts have been issued. Based on the profitability and resilience to changes in estimates, the portfolio of, for example, car insurance, as you can see on the slide, will be divided into a minimum of three groups. A group of profitable contracts with no significant possibility of becoming loss-making, a group of other profitable contracts, and a group of loss-making contracts. When grouping those contracts in three groups under premium allocation approach, the entity shall assume no contracts in the portfolio are onerous at inception unless facts and circumstances indicate otherwise, as we explained on slide 10 of this webinar. In addition, regarding profitable contracts, the entity will need to distinguish among different levels of profitability in order to separate contracts with no significant possibility of becoming loss-making. The possibility of groups becoming onerous depends on the likelihood and expected magnitude of changes in assumptions. In deciding the above three groups, an entity should use information provided by the entity's internal reporting. When considering internal reporting, the entity may choose to divide those groups even further into more groups. After grouping contracts based on the profitability, the entity should separate contracts issued more than a year apart. The entity does not need to follow its annual reporting period in determining the grouping. For example, if the entity year end is end of 2017, a group could include contracts issued from the beginning of March 2017 to the end of February 2018. It is important to remember here that after initial recognition, grouping of contracts cannot be reassessed. In addition, IFRS 17 provides an exemption from grouping contracts with different risk characteristics separately if laws or regulations prevent insurers from pricing for those risk indicators. For example, a risk indicator is gender, so for example to distinguish male or female drivers. And the regulatory restrictions could be in the form of constraining pricing or setting benefits. In this situation, the exemption effectively allows the entity to ignore that risk characteristic, which is gender, for determining the grouping, and establish one group for male and female drivers. Now, let's consider the presentation and disclosure requirements. And let's start with the main changes introduced to the balance sheet by introducing IFRS 17. Based on existing practice, typically a group of insurance contracts would be presenting using separate line items on the balance sheet in both the asset and liability section of the balance sheet. So, for example, as you can see on the slide, there will be a line for deferred acquisition costs, policy loans on the asset side, and unearned premium on the liability side. Applying IFRS 17, that presentation will be simplified, and the entity will present the group of insurance contracts as one line item that will reflect a bundle of rights and obligations. This means that a single group of insurance contracts could be in an asset position when, for example, acquisition costs are paid before any other cash flows. However, most often, a single group of insurance contracts will be in a liability position. This is because the entity will receive premiums in advance for the coverage provided in the future. It's worth remembering that a group of insurance contracts may change between an asset or liability position over its life. In addition, it's worth mentioning that the entity will present reinsurance contracts separately from the insurance contracts. Now, let's think about the statement of financial performance. Under IFRS 17, investors will be provided with richer information because they will see the information about two drivers of profitability, the insurance service result and the net financial result. The distinction will reflect how successful an entity is in providing insurance activity versus investment activities. Under IFRS 4, that information was often not provided. So if you consider IFRS 17, insurance service result will comprise of insurance revenue and minus insurance service expenses. So insurance revenue will depict the provision of coverage and other services arising from the group of insurance contracts. Insurance service expenses will comprise of incurred claims, an amortization of acquisition cash flows, changes in estimates related to claims that have already incurred, and changes related to the estimates of losses on onerous groups. Now, if you think about the insurance finance result, it will comprise of insurance finance expense minus investment income. Investment income will be accounted for under another standard, for example, IFRS 9. Insurance finance expense will reflect the time value of money and the effect of financial risk on insurance contract. Overall, we expect that fewer changes to the statement of financial performance are expected for non-life insurance compared to life insurers. And the major change for some non-life insurance will be reporting investment activity separately from the insurance activity. Now, Maria, can you explain a little bit about further information about insurance finance expenses?
Thank you, Isa. Let's explore the insurance finance expenses presentation. IFRS 17 allows to choose as an accounting policy to present insurance finance expenses arising from the liability for incurred claims in profit or loss, or to disaggregate those expenses between profit or loss and other comprehensive income. If an entity chooses to disaggregate the insurance finance expenses, the entity will present, in profit or loss, a systematic allocation of total insurance finance expenses to the period using the locked-in rate at the date when the claims are incurred, whereas in other comprehensive income, the entity will present the difference between amounts presented in profit or loss and the discounting effect on the liability for incurred claims using current discount rates reported on the balance sheet. Please note that, as explained in the previous webinar, the liability for remaining coverage uses locked-in rate, but at the date the contracts are initially recognized in order to accrete interest. Because there is no need to update that rate, there is also no need to disaggregate finance expenses resulting from the liability for remaining coverage between profit or loss and other comprehensive income. Moving from the financial statements themselves to the disclosures, IFRS 17 prescribes a set of disclosures to be provided under the simplified accounting. For contracts accounted for using the simplified approach, the entity will not report all the disclosures that apply to contracts accounted using the core requirements. Due to the simplification of the model discussed in the previous webinar, an entity will not have information about blocks such as the present value of the cash flows, the risk adjustment, and the contractual service margin for the liability for remaining coverage. The disclosures of the blocks of the present value of cash flows and the risk adjustment under the simplified approach are required only for the liability for incurred claims. This is because, as discussed before, the liability for incurred claims is measured using the core requirements. Additionally, there are specific disclosures for the simplified approach. The entity is required to disclose information about which criterion makes the contracts eligible for the simplified approach and which practical expedient the entity has chosen to apply. That's the end of today's webinar. We hope you found it useful. As stated before, we intend to produce future webinars and other materials to support the implementation of IFRS 17. Thank you for listening to today's webinar.
Thank you and goodbye.